This is Corey Daharsh with Advanta IRA, and I'm here with another educational webinar. Today's topic is going to be fair market valuations and required minimum distributions. I'll just be going over the basics of these two different factors in the retirement investing world. So if you have any specific questions, please feel free to address those in the questions box. I'll take them towards the end of the presentation, or you could reach out to me directly with any follow-up questions that you may have on a personal basis. All of my contact information is here on the screen. Just to give you a little bit of background about myself, I've been with Advanta IRA since 2016. Served a number of different roles with the company. I do have a CISP designation, which stands for Certified IRA Services Professional. I've had that since 2018. It does require continuing education credits on an annual basis. So I'm basically about almost a 10-year expert in alternative retirement account investing. Again, you can email me, you can call me at the phone number listed there. I'm gonna cover a basic background on retirement account investing in Advanta IRA, and then I'm going to hyper focus on fair market valuations, and then after that, required minimum distributions today. If you'd like a copy of today's slide deck, you can also email me directly. I'll be happy to share that with you. It'll be a PDF version of today's presentation, so feel free to reach out directly if you'd like to receive that content. And the recording of this webinar will also get emailed to everyone that registered today, and it will also go onto our YouTube page within about 24 hours, so you could watch it back at your own pace, at your own time, share it with friends, family members, anyone else you think will benefit from this content. So to get us started, I just want to tell you a little bit about Advanta IRA. We are a full-service, self-directed administrator and custodian. We've been in business for over 21 years. We've got roughly 15,000 active clients that hold just over $3.5 billion in assets under administration. And each client of ours has a dedicated client account manager appointed to them. So a one-to-one white glove customer service representative that's there to answer all your questions, assist you with any investments, transactions, strategies, rule and regulation questions like we're pretty much covering on today's presentation. But that is your one-to-one person that you'll deal with once you have an existing account. Prior to that, if you just want to reach out and learn more and maybe set up an account, you'll work with someone like myself on the business development team just to get you all started, help facilitate getting the funds moved in from your existing retirement plans. And all in all, that process typically is just a 15 to 20-minute phone call, an application that takes you about 15 minutes to complete, and roughly about a week's time to get the funds moved over from your current retirement plan into a self-directed account. Before I get into any more content, I do want to share a brief disclaimer. I'm here to provide you educational content. I am not an expert in tax, law, or financial advice specifically. So if you're looking for specific tax advice, legal advice, or investment advice like financial advice, you will need to reach out to your own CPA attorney or tax preparer or financial advisor. We do have a professional resources tab on our website if you're looking for legal services or something that are familiar with retirement account investing in the alternative sector. Otherwise, it is completely up to you to build your own team of people that you know, like, and trust to work with in those various capacities. So if you're not familiar with a self-directed retirement account, it's basically an account with a non-fiduciary or not a financial advisor that allows you to invest into alternative asset classes that those fiduciaries or financial advisor companies will not let you hold. For example, real estate, private lending, precious metals, private placements or syndications, limited partnership type investments, cryptocurrency, and much, much more. It's really easier to tell you what you can't invest into with a self-directed account than to tell you all the number of things that you can invest into. So basically put, you can invest in anything you like with a self-directed account, as long as it's not a life insurance policy or a hard to value collectible like antiques, fine wine, artwork, things of that nature. Otherwise, there's likely a way to strategize. There are some rules about who you invest with or who you buy or sell the asset to or from, but I'm not going to cover those more directly today. That's something an existing client can ask their client account manager, or you could pull up one of our just basic investing webinars to learn more. It's usually the first 5 to 10 minutes of the webinars when we're talking about actual investment strategies. If you have not heard about a self-directed retirement account, that's pretty common. We don't see a lot of people that have really known about these for a long time that don't take advantage of them. It's more so people that haven't ever heard of a self-directed account that learn about it and then decide that they're ready to diversify their retirement portfolio and at least move over a portion of their retirement funds to a self-direct account. All in all, these accounts have been around just as long as the managed accounts you probably have. It's just a lot of people don't know because you're with a fiduciary or a financial advisor, and they usually tend to lean on telling you it's too risky, too scary, too volatile to take your money out of their hands where they're getting interest or points or investing your dollars on their behalf to actually invest it on your own behalf into assets that you have your own vested interest in or your own specific expertise into how to generate passive income with your own dollars. Only about 4% of accounts in the US are being self-directed, and that's an industry that's got about $40 trillion in total in it. So word of mouth, sharing this information, sharing the knowledge about self-directed retirement accounts with people you know always helps. And good content like we put out, educational content, just to teach people and kind of spread the word is what we're doing to try to spread awareness and knowledge about self-directed retirement investing. So it's very important, I just mentioned, something that you have expertise in or you have a specific knowledge base in. On our side, real estate's one of the top asset classes we see, but you can invest into just about anything. We do a webinar twice a week on the, or I'm sorry, twice a year on the most unique investments we've ever seen. So again, I've been doing this just under 10 years. I've seen some of the craziest things under the sun because people have unique niches and expertises and they know how to generate income in ways other people don't. And if you can utilize your retirement funds as a bucket of money to do so, why would you not? Otherwise, you're taking matters into the hands of a fiduciary. They're investing it in the stock market. That's its own roller coaster. So maybe not switching someone's full portfolio to a self-directed account, but at least diversifying is a way a lot of people have hedged their bet against the stock market over the past few years. Quick example here, some of the more unique investments: raw land, farmland, timberland, cargo carriers, 18-wheelers, airplanes, movie projects, sports teams, burial crypts, cryptocurrency. We're seeing a lot of people jump into cryptocurrency over the past 3 or 4 years. It can be as unique as you want it to be. It can be as standard, you know, owning a rental property for short-term, mid-term, long-term rental income, a vacation rental home, anything like that. We can definitely help you. We've got educational content on plenty of these different strategies. Your account manager can walk you through the how-to as far as executing any investment in a specific asset class. That's what we're experts in and here to help with. So turning attention to today's topic at hand, what is a fair market valuation? Basically, a fair market valuation is the only reporting or tax documentation, if you will, that you have to file for your retirement investments on an annual basis. These values are supposed to be provided to the IRS or dated as close to December 31st of any given calendar year as possible. You may be allowed to perform certain valuations yourself, but we always encourage you to get an independent third-party valuator, whether that's your own CPA or a financial representative from the firm that you invest with. You can go to the county assessor's website to pull an assessed value of any rental property you hold. Don't wait until the last minute. At least in our case, we send out notices in around November to tell clients when the FMVs are due. And then we end up having to follow up several times for clients that don't turn them in a timely manner. And ultimately, if you don't turn it in after an extended period of time, sometimes we have to do the research ourselves and possibly not provide the fully accurate value because the client isn't turning that in themselves. So it's really important to just know it's a very simple document, very easy to put this together. And I'm going to go over each specific asset class a little bit later and give you a brief example of how simple it would be to put together a fair market value for various asset classes. And just to also inform you, the IRS uses this valuation to learn about investing trends, see what asset classes are performing well, what asset classes are not performing well, to make decisions on upcoming rules and regulations. And this is also utilized in creating what is your required minimum distribution for the next calendar year, which I'll talk about later in today's presentation, the required minimum distribution. Again, it's calculated based on your fair market valuation or total value of your retirement account at the end of 1 year, how your required minimum distribution for the following year is going to be calculated. So some basic rules about fair market valuations. You do have to provide a separate valuation for each asset in your account. Valuations are assigned as of December 31st or as close there as possible as you can. The value of your assets based on the fair market value, not the actual cost. So if you bought an asset, let's say at $50,000 and you've owned it for 2 years, you don't just keep putting $50,000 on that valuation. That asset may not be valued at 50 anymore. It may be down to 35. It may be up to 70. Who knows? That's why it's important to provide this fair market valuation accurately on an annual basis. Again, an independent, neutral, third-party evaluator is very encouraged, not necessarily required, and it should not be a disqualified person to you, meaning yourself, your spouse, your parents, your children. It can be other distant relatives if they have the expertise in valuing the asset in question, but it should not be a disqualified person to you. You are not required to pay for a valuation, but if payment is necessary, it is important that you pay for that valuation using the funds out of the retirement account. That should not be paid out of pocket. That could be seen by the IRS as you giving a personal benefit to your retirement account. So make sure if any expense does come with a valuation, let's say you've got real estate and you go get an actual appraisal done, you're paying for that appraisal with your retirement account. I'm seeing here on my GoToWebinar panel, some people are trying to utilize the hand raise feature. If you didn't catch at the beginning, I am not utilizing the hand raise feature for this presentation. You can go ahead and put your questions in the questions box in the GoToWebinar panel. I'll address those later on after I get through most of the actual content here, or you could feel free to email me directly. My email address is cdaharsh@advantaira.com. I had it up on one of the first slides in the presentation. I'll have it up at the end of the presentation as well. But the audience is going to be muted for today's presentation. And because I'm just running this myself and have a lot of content to cover, I'm not going to stop in between different slides and answer questions just so I can get through concurrently with all the content that I'm trying to share with you guys. So fair market valuations must include any recharacterization amounts. So if you're recharacterizing from one plan type to another, any conversions from Roth or a traditional account and other types of account changes, rollovers, so moving money out of an employer-sponsored plan into an IRA, which could be traditional or Roth, contributions into your account, required minimum distributions are started for the upcoming year if you're eligible. So again, this is what is forming how much the IRS tells you you have to take out as a required minimum distribution because they're looking at the total value of your account and the life expectancy chart. It's a little bit of foreshadowing. I'll get into that more thoroughly later. And what we use to submit your fair market valuations to the IRS is Form 5498. That is typically filed in the spring of each year, but you'll typically get your annual statement that provides you all that documentation in the middle portion of January. So just taking a brief snapshot of the different asset classes that you may be valuing, depending on what type of assets you hold in your account. You may have a brokerage portfolio, physical real estate, private equity or limited partnership, liabilities, so loans that you've taken out in the name of your retirement account, notes that you hold, so assets receivable, private loans, mortgages, secured loans, convertible notes, qualified participant loans if you're someone with a solo 401k plan, and then other miscellaneous assets as well fall into just kind of the other asset class listed there. So the next few slides are going to be a breakdown of various asset classes and a very simple explanation as to how to easily fill out a fair market value form for that asset class. I'm starting with a brokerage account. So our form, it may be a little bit updated from this actual document, but it looks basically like this. And if you're an existing client of ours and this asset's been in your account for longer than a few months, it's likely when we reach you with the initial notice in November, this form is mostly filled out for you. We'll already have your name, the account number, the name of the asset, the type of the asset, and what we call the QSIP, or the identifying unique code for your asset. And what you're responsible for is filling in the actual dollar value, dating that value, providing any possible supporting documentation, listing a valuator if you utilize one, and then signing the document and returning it to us. So for a brokerage account, a brokerage portfolio, it's very simple because you really just need to look at the total value of the brokerage as of the date that you file this valuation. So let's just say you have a Advanta IRA account and you have a brokerage account through that Advanta IRA with Axos. That's a company we work with pretty consistently. You would just pull up your Axos profile based on the various positions you hold, see what your cumulative total in that account is, and add that number down there, dated as of the date you looked it up. So in this case, we've got Billy Brokerage. He's got about $15,500 in his brokerage account. He dates it as of the date he executed this form. In this case, maybe he has Albert Accountant. I actually looked that up for him. So Albert signs it as the valuator, Billy signs it as the account holder, and that form just needs to be turned back in to Advanta IRA. Brokerage accounts, very simple because you're just looking up what the actual root number is as of any given day that you're providing for the date of valuation on another platform that's the actual brokerage platform. So the trade values and whatnot are going to be static for at least that point in time specifically. For real estate, a little bit different because real estate asset has a few different ways you could value it. So in this case, we've got Regina Rawland. She's got a property on Champagne Lane that needs valuation. What you can do when you have real estate is look up the county appraiser's records, as I mentioned earlier in the presentation. That can be used for every year because the appraiser does provide an updated valuation on an annual basis. That's how they file taxes against properties. So you can go to the appraiser's website, do a quick search for your property, look at the appraised value and provide that. Now, if you're doing rehab work on the property and for any reason you want to make sure it's valued higher or lower, you may want to actually go get a physical appraisal done. Also, if you're approaching required minimum distribution age or just by your own free will and accord wanting to distribute this property out of your retirement account, you may want to get a certified appraisal done, which you would pay an independent third party to do. In that case, instead of Jim Appraiser listed as the valuator, you would have the independent third party valuator that did a certified appraisal go ahead and sign the valuator information section. I'll also note just ahead of time, but I'll reiterate it later, if you are at required minimum distribution age and you have real estate in your retirement account, you must get a certified appraisal at least every 3 years for as long as that property is held in your retirement account. So from the year in which you turn age 73, which is when your required minimum distributions start, you'll have to get a certified appraisal. And then 3 years later, if you're still holding ownership of that property in your retirement account, you'll then have to go get another certified appraisal as well. The next asset class I'm going to talk about is private equity or limited partnerships. This could be a limited partnership into a real estate syndication. You could own shares of a private stock of business, LLC. It could be any different partnership setup that you may have. Ultimately, in these scenarios, you're buying in at a certain dollar amount. Kind of similar to the example I gave earlier. You buy in for $50,000 and maybe that's 5 shares of ownership. But 2 years later, that isn't necessarily still valued at $50,000. That partnership, that private stock, that LLC may have adjusted in value either up or down. So it's important to note what typically the price per unit or price per share is at the time you're providing the new valuation. And you can do that either by having your own accountant or CPA do the calculation and verify that. If you're investing into a syndication, you could ask the general partnership team to provide you an updated price per unit or price per share. You can possibly do that calculation yourself if you know, hey, I invested 50, that 50 is now worth 70, I own 5 shares of ownership, you do the math there, and you can verify that further. But with a private equity investment, usually there is an independent third party that you can go to and take the work off your plate to provide an accurate valuation of these types of asset classes, whether that be a letter from your accountant confirming the price with the partnership team that you invested with, or maybe the financial guy in an LLC if you're putting together a fund with some friends and all co-investing through an LLC. There's a number of different ways to do it. But again, it's important not just to say, hey, I invested $50,000 into this limited partnership 5 years ago. I think it's still worth 50, but I'm not sure. I'm just going to list 50 on the form. That's not the appropriate way to handle this type of valuation for this asset class. And it's really not that difficult to do so accurately in general. So liabilities, this is again, more of a niche scenario. We don't see as many loan assets held in retirement accounts as we do the other assets. But let's say you took out a non-recourse loan in your retirement account to buy a piece of property or another asset where a loan was required. The loan amount that you initially took is not going to be the consistent valuation because you're making payments on that loan. In some capacity, the value of the loan is going to be lesser and lesser until you have a maturity or a payoff. So what you would typically do in this scenario is you'd follow the amortization chart or the initial loan agreement. So let's say in this case, Nancy non-recourse took out a $150,000 loan 5 years ago. She follows the amortization chart in the actual loan document that says, okay, I borrowed $150,000. I've been making payments on it for 27 months. Follow the amortization chart. I now have a liability value of $133,847 as of the end of November 2024 in the case of just my screenshot here. In this case, the attorney that actually drafted the loan documentation and the amortization chart is able to execute that as the valuated third party, and Nancy signs it and sends it back. Again, pretty simple. You're just following the actual paperwork for the underlying investment transaction. Notes receivable. So notes receivable, there's a few different ways to value it. You would still typically follow the amortization chart, but depending on how the loan is structured, an unsecured loan, a secured loan, a mortgage loan, it may be interest-only payments and a balloon maturity at the end. So if you're only receiving interest payments back from your borrower, then the principal value of the note does stay at the $50,000 that you initially lent, or the 10, 15, whatever dollar amount that you initially lent, because you're only receiving interest payments back into the account. It really depends on how that loan agreement is drafted up. But if you are having principal and interest payments sent in, that is where it's very important to follow your amortization chart and see, okay, I loaned this person, entity, whatever it may be, $10,000 6 years ago. That's 6 years of payments. They've never missed a payment. Let's follow the amortization chart. And now that loan is currently worth $5,000. Very similar to the last one with notes receivable, you just follow the amortization chart based on the total amount lent, the total principal paid back against that loan as close to the end of the calendar year, 12/31 as possible. You typically don't need a valuator in this scenario because in a lot of cases, you're the one that drafted the loan, you and the borrower together. If you did use some sort of third party, then they can sign as evaluator, or even the person lending the money to you that signed off on that amortization chart in the borrowing agreement with you. The qualified participant loans, again, I mentioned this earlier, these are certain loans that are only able to be taken out by 401k plans. So only a subsector of our clients even have the capacity to take a qualified participant loan. But if you are someone that qualifies for a solo 401k or has one with us, yes, you can borrow money against that 401k plan. When you're doing that, there is a certain set of loan documents that we provide you and a certain set of note details. So the most you're allowed to borrow is $50,000 or 50% of the account value. If 50% of that account value is less than $20,000, you can borrow up to $10,000. You have to make minimum quarterly payments back into the account. The interest rate has to be plus or minus 1% of the current market prime. And you have to have a 5-year maturity or balloon after 5 years. So depending on within that criteria, how you structure the loan, You could just be making interest payments back, not paying back any principal, to where the total principal that you borrowed day one is going to stay the total principal or value of the loan until the 5-year mark where you have to pay the mature balloon note back into the account. You could be making principal payments in addition to the quarterly interest payments, and the value of the loan would decrease. So either the loan agreement or the amortization chart, like the last 2 slides, are the appropriate way to find what the accurate value is on an annual basis for your qualified participant loan. And then other assets. So various unique assets. In this case, precious metal is one that we see very often, and precious metal is relatively easy to value as well. So this is not the value that you purchased the precious metal at. This is the current value at the point in time you're providing said valuation. So you verify a rate with an active precious metal dealer and basically cite that rate as your valuation principal. So if I have 1 ounce gold American Eagle coins in my retirement account, I'm going to go on the various dealer platforms and see what that is currently trading at. It's completely up to you to pick one versus the other or have a third party do this for you. But once you have a set dollar amount for what that precious metal is currently actively being sold at, or you can surmise that to your best ability, multiply that by the total amount of those coins you have. So let's just say I had 7 of those coins in there. The value of my ownership in this asset is the current set price times 7 units. Date that valuation, possibly cite, like take a screenshot of the dealer's page from which you found that valuation, and turn that into your client account manager. So that's the basics of fair market values. Now, what I'm going to turn my attention to now is required minimum distributions. So again, I've said it a few different times, a required minimum distribution is the amount that the IRS tells you you have to take out of your tax-deferred retirement account once you reach a certain age. So when you put money into a retirement account that's tax-deferred, you're getting a write-off. For a traditional or Roth IRA, $7,000, $8,000 a year is your maximum annual contribution. So when you put that $7,000 or $8,000 in, you're getting to tell the IRS, I earned $7,000 less this year, don't tax me on this amount. I'm put that money into a tax-deferred retirement account. And that account grows and grows and grows on a tax-deferred basis while you invest it. And then once you reach this required minimum distribution age, the IRS says, okay, now you need to start taking money out of this retirement account, and we're going to collect taxes on it. As of right now, that required minimum distribution age is 73. So when you reach age 73, you have to start taking required minimum distributions. The year in which you reach age 73, you're allowed to defer up until April 1st of the following year. But after that following year, or starting that following year and moving forward, you have to take your RMD total by December 31st of that given year. The RMD, as I said earlier, is calculated by dividing the prior year-end balance in the retirement plan by the applicable life expectancy chart published by the IRS. There's a few different charts because there's a few different scenarios for your own case. So depending on your case scenario, you'll look at chart 1, chart 2, and you'll verify your age, the total value of your account, and you can make that calculation pretty easily. Administrator or a third party can make that calculation for you. There is a worksheet on the IRS's website, which I'll give you a link to in a couple slides if you want to research that yourself. On our end, our annual statement will typically tell you what your RMD amount is so that you know going into that year how much throughout the year you need to take out of your account to satisfy your RMD. It's important to note that each account has a designated RMD amount. So if you have an IRA that is traditional or tax deferred with us at Advanta IRA, and then you also have a fiduciary IRA over at Edward Jones, Merrill Lynch, T. Rowe Price, Fidelity, Vanguard, that is going to have a separate RMD amount as well. Every account you hold that's tax deferred is going to have an RMD amount associated with it, but that does not mean you have to take that amount from that set account. So if you have accounts that are more liquid than others, or assets that you really want to hold on to as opposed to liquidating or taking as a distribution in kind, you can say, okay, my RMD amount for my Advanta account holding a rental property is $15,000 for this tax year, but I have $85,000 over in my account with fiduciary IRA, name it yourself. I can go take a distribution out of that fiduciary IRA for $15,000 plus the distribution that they require as their required minimum distribution to satisfy my overall RMD amount. So as long as you satisfy the total amount that each custodian tells you, it doesn't matter where you take it from in regards to your tax deferred accounts. There's a little bit of a niche in rules for RMDs based on inherited accounts. So let's say someone passes away and they leave you as the beneficiary to their account. So then you have the ability to take on an account that was held by one of your loved ones as your own retirement account if it's your spouse, or just by setting up a inherited account if it's not your spouse. So the rules are a little bit different than your own RMD for your own individual retirement arrangement. So breaking that down a little bit further, if your spouse passes away, as the spouse, you are allowed to transfer ownership into your own name. So you can what's called treat as your own. You can take your spouse's account and push it into your own account, and then you follow your own RMD rules based on your own age. If you either choose not to do that or are not eligible to do that, your other options are that you'll need to begin taking the RMD either when your late spouse would have reached required minimum distribution age, or the year after their passing. If they passed away before taking any RMDs, you have basically until December 31st in the 10th year after they pass to withdraw the entire balance. So it's about a 10-year rule if they had not started taking RMDs to liquidate that entire account. If you're a non-spouse, you cannot recharacterize the account into your own name. And again, there's slightly different distribution requirements. The 10-year rule essentially applies. And if you inherited a Roth IRA from someone, you may not have to take RMDs at all. Roth is, again, post-tax retirement dollars, so you did not get that tax write-off, or you handed in that tax write-off to convert the money to Roth. Distributions are typically going to be tax-free as long as you're in qualifying circumstances. Roth IRA rules are a little bit different than today's topic, so I'm not going to go down that set of tracks today. But with an inherited Roth account, you typically are not going to have RMDs, and specifically typically not going to have taxes on your distributions just because of the way the Roth account was set up in the first place. So a few final rules with the RMDs. RMDs cannot be rolled into another retirement account. So meaning I can't take an RMD and then just push that money into a retirement account as a rollover later. And you cannot Roth convert RMD or retirement accounts from traditional or tax deferred account to avoid or circumvent RMDs. So if you have a retirement account that you've inherited, the only way that you can ever convert that to Roth is if that were your spouse's account, you treated it as your own, so added that money to your own retirement account, and then you could then Roth convert that typically at your discretion. Otherwise, you can take your RMD as cash or as an in-kind distribution. If you are going to do an in-kind distribution, make sure you're following the proper protocols for valuing the asset so that you can distribute it in kind at your discretion. For more information or to see the actual rules and specific things I'm citing and referencing here, you can go to the IRS's website and look up publication 590-B. That is the IRS's rules for distributions out of retirement accounts. If you do want a copy of today's slide deck, this is actually a hyperlink here where I have publication 590-B. So you can click on that directly from the PowerPoint presentation. Again, I mentioned at the beginning of today's presentation, I'll be happy to email this to anybody. Just email me directly and I can very easily send you a PDF of today's slide deck. just a quick closing here, and then I'm going to get to the questions in the questions box. We do a lot of educational webinars, typically 2 of these educational webinars a week. We have a podcast called the Alternative Investing Advantage Podcast, and we have a blog on our website as well for more interesting news about self-directed retirement investing, educational content, conversations with experts in various industries of investing. Please feel free to check out any of our Learning Center opportunities and available options. It's real easy to set up a self-directed account. As I mentioned at the very beginning of the presentation, it takes about a week to a week and a half to open an account, get it funded, and be ready to invest. You're looking for your own investments, your own discretion. Make sure that you've done your own due diligence because you don't have a fiduciary or a financial advisor. You're taking those matters into your own hands when you're self-directing so that you can invest into various asset classes that you're actually interested in or have expertise in. I'm going to put my contact information here on the screen, and I'm going to pull up the questions from the audience and start kind of reading through some of these and getting some of these answered. A few people at the very beginning were asking about the audio. I know I'm not on mute, so I believe that was working well. Apologize for any audio issues for you out there. I'm a CPA and licensed appraiser. Can I prepare FMV report? Who provides Roth IRA account service? You can cite yourself as your own valuator. We do implore people to get an independent third-party valuator, but that is not an actual requirement. So yes to that person. You can value your own assets. As far as who provides Roth IRA account service, we do offer Roth accounts. I'm not sure what specific service that person may be asking for, but feel free to reach out to me directly. Does this apply to tax liens? Tax liens would typically go under the real estate asset class. So depending on what you purchase that lien for and or what the value of the lien is worth, calculation there would be the typical valuation breakdown. I see 2 different dates. Do they need to be filled in by 12/31/25 or 3/31/26? The valuation, as accurately as possible, should be valued by the end of any calendar year. So for your accounts and assets held in your account throughout the course of 2025, the current year we're in now, you should be providing a valuation to your administrator as close to December 31st as possible. For real estate and self-directed Roth IRAs, no RMD, is it better to estimate value on the high side or the low side? I can't answer that question. That would be something to ask a CPA or a tax preparer, and based on your specific needs. I mean, yeah, it's best just to get the root value, not necessarily an estimate or a comprehensive market analysis. Just get the value from the county appraiser, the appraiser in that municipality, so it's not necessarily a guess. Otherwise, I would say speak with a CPA or tax preparer, get their expertise and guidance on that. What if you made a non-secured loan and the borrower stopped making payments, so the value of the loan is the same as it was last year? No, the value of the loan is not necessarily the same it was last year. The value of the loan is either, yes, the same as it was last year, but not necessarily. Wherever the principal balance of that loan is outstanding, or if you genuinely do not think that you're going to get anything back on behalf of that loan, you can have a third-party valuator value that asset down to a nominal amount, like a $1 or something like that. Or if you genuinely think you're never going to get paid back on that loan and it's a lost or a sunk asset, you may actually value it down and distribute it out of your retirement account. So cut it free as a loss and no longer hold it in your account. That is something your account manager and or your CPA can answer questions and assist you with further. But if you have a distressed asset, you don't necessarily want to leave it at the last known value if your hunch or inclination is that you're not going to get any further returns from it. So it would be definitely something to look into a bit further. With regards to precious metals, do you have to list each type of asset? Yes, each individual different type of precious metal. American Eagle American Eagle, Silver Bullion, etc. They are each different assets, so they're each going to have a unique value. It does not necessitate each individual coin. So if I've got 3 1-ounce American Eagle coins, just the spot value of the 1-ounce American Eagle coin is what I'm looking for. I multiply that number by 3 because I have 3 of those in my retirement account, and that's the value of the asset. I have a non-performing / defaulted note receivable unsecured loan in my traditional account. How would I determine the FMV? I believe I just answered that about 2 questions ago. Consider with your CPA's advice and speaking with your client account manager if it's worth valuing down to a nominal amount or even possibly writing off out of your account and closing out that asset as lost cause. How does an in-kind RMD distribution work? With precious metals, can you just bring them home? Yes, technically you can. So an in-kind RMD basically means you have to provide an updated valuation within 30 days of when you expect to distribute that asset out of your retirement account. So if I had real estate, for example, and I wanted to do a distribution of the real estate out of my retirement account to myself personally, I'd have to go get a certified appraisal done, and then within 30 days execute a distribution request based on that appraised value to take either the full property or a portion of property percentage-wise based on the dollar amount I'm trying to equate to deed it over from my retirement account to myself. In the case of precious metals, you do the same thing in principle. You get an updated valuation, you execute a distribution request, and you tell the depository currently holding those precious metals, they're no longer owned in my retirement account. I want to take personal possession of them, and you have them shipped to you or you pick them up or wherever it may be. But once it's no longer officially owned in your retirement account, you've distributed it and you own it personally at that point, you then can have them at your home. See, as per Advanta's requirement, I opened a business bank account in the name of my self-directed IRA. I also invested in a piece of real estate. Do I need to provide a separate FMV form for each? Also, can I change banks? So what this person's referring to, I believe, is checkbook control. We don't necessarily require everyone to just have a business bank account in the name of their retirement account. That's only if they want to utilize what's called checkbook control, the checkbook IRA, or a single member LLC. In this case, this person invested into real estate, so that is a common strategy for real estate investors. And furthermore, with a valuation, in this case scenario, you're not valuating the actual real estate, because that's not the asset we have on record for this person. We have the LLC. So that goes back to the LLC, limited partnership, private stock valuation class that I talked about earlier. So this person would need to provide a cumulative value of all assets owned by that LLC as the valuation they turn into us for the LLC itself. So that's typically going to be the cash that's still sitting in that business bank account, the appraised tax record value of that property, any other assets that this person invested into in the name of that LLC, whether it's precious metals, whether it's another private loan, another piece of real estate, put together essentially a spreadsheet, a cumulative total of everything that that LLC owns, which means your IRA owns by extension of that LLC, and that is the total that you would list on the fair market value form. Sorry, I moved my mouse and the list jumped. Give me 1 second, everybody. If I devalue my LLC shares done by a professional 1 year, but haven't done it in previous years, will the IRS flag that? That's a question for a CPA or tax preparer. I don't know how you would just arbitrarily devalue your LLC shares. So I don't know if the IRS would flag that. I don't even know how you could just say I devalued them but didn't in other years. So that's not something I would have expertise in answering or assisting with. Would you be able to show where to get asset values on the county website? Can you attach that screenshot with asset values? No, I cannot. I can explain briefly, but it really depends case by case and where that physical real estate is. So our main office is down in Clearwater, Florida. So you would essentially go to the Pinellas County Appraiser's website and based on their search criteria, look for the tax assessor's page and start finding a search bar so you can search the actual property location, and then you can typically pull up the assessed value for that property. There's countless municipalities across even each state, but each different area you may be investing into. So that is something, it's going to be so varied. There's no one set screenshot that I could provide someone to verify that, but whatever municipality is, try to find their tax assessor's website, try to find the search bar there, search the actual property address, and then you should see just like a PDF that you can download or pull up that'll tell you what the assessed value is. And that's what they use to create what your tax bill, the real estate property tax, is going to be. So it should be present on any asset that's owned. Will you be able to share the presentation and video recording? It will be emailed to everyone that has registered today. It'll also go up on our YouTube page within about 24 hours. But that, excuse me, if I did an appraisal 3 months ago, can I use it, or it must be valued closer to the end of the year? You can use that appraised value from 3 months ago. That's perfectly fine. You would want to date it as of whatever that date was 3 months ago, though. We're looking for as close to the end of the year as possible, but in certain scenarios, we understand the best valuation for an asset may be a little bit off from that. An email from Advanta recently said FMVs due March 31st, 2026. Yeah, that's the drop down last date that we're very at the last minute hoping to receive them. We want them, and the first notice that we send out typically is dated, try to get them to us by the end of the calendar year. I believe March 31st is that, hey, you're late, we're going to have to go different measures if you don't turn it in at that point or by then. Does Advanta provide real estate investment opportunities? No, it's our position as a self-directed administrator is that we cannot endorse, promote, or provide any investment opportunities. That is completely the self-directed investor's discretion to find who, where, and how they want to make their investments. Having said that, we do a call once a month called Pitch, Promote, and Prosper. You can register for that. It's typically the final Friday of the month. A little bit changed with the holiday season here, but go to our events page, Pitch, Promote, and Prosper, or Virtual Networking Exchange. It's an elevator pitch style call. Everyone gets to say who they are and what they're looking for or what they have to offer, so you can network with people there. Otherwise, check out your local real estate investor association, other types of meetup groups to find people that you're interested in investing with. If I have Advanta IRA checkbook account and real estate, would that require 3 different forms? It depends on how you have them structured. If the real estate's within the checkbook account, I answered that question earlier. If it's a checkbook account, separately you own real estate custodially with us, then yes, multiple fair market valuations would be required. How do RMDs affect real estate? Can one hold the real estate and draw rental as RMD? No. The rentals are income generated by the asset. So that coming into your account doesn't necessarily go against your RMD amount. You would have to actually draw cash out of your retirement account to suffice the RMD total. Looks like I've pretty much gotten through all of the questions here. So I'm going to go ahead and wrap up at this point. Again, if anyone has any additional questions that come up, your first order, if you're an existing client of ours, will likely be just to reach out and tap your client account manager. I'm sure they'll be able to answer questions for you on RMDs or fair market valuations. If you do not have an active account with us, you can contact me directly. All my contact information is here on the screen. I'll be very happy to answer any questions, assist you, and hopefully get you set up with an account to start self-directing. I thank you all very much for your time and patience here on today's webinar and give me some time to read through and go through the Q&As. Have a wonderful rest of your day, and we will see you next time. Thank you.